Thank you so much for joining us. My name is Jesse Hurst, Certified Financial Planner and CEO here at Impel Wealth Management. Joining me today is Nathan Alish, also Certified Financial Planner and Accredited Investment Fiduciary. Nathan will be, we're going to break this up like we normally do. I'm going to do the first few slides, kind of give the overview. Nathan's going to give a lot of the meat and data of the presentation in the middle. And then I'll finish up the last few slides while Nathan prepares to do Q&A. Just as a reminder to everybody, depending on where you scroll your mouse on your screen, it should either be at the top or the bottom of your screen. You should have like a toolbar that pops up, and there's a Q&A button. So we know that during times like this, there's lots of questions when you see uncertainty, volatility in the market. But please feel free at any point during the meeting to hit that Q&A button, type your question in. Nathan will be feeding those over to me here at the end of today's session. So we'll try to remind you of that one or two more times here before we finish up today. So with that, the one other thing I'd like to say is she's not on the screen today, but she joined us a month ago, January 3rd. Irene Zarowski is our newest Nathan. So last year we are happy and pleased to say that thanks to the confidence and generosity of many of you listening, Nathan and I received 43 new referrals last year. And I just told Nathan, I'm too old to keep up with that many referrals. We need to hire somebody else to keep it going. So with that, Irene is a certified financial planner. Prior to that, has a background in mortgage and banking experience, and you'll get to know her and see her around the offices here coming up. So with that, I'd like to open up today's by just kind of taking a look at this title, right? You know, one of the things that we found from 2020 was that, you know, it was almost 2 years ago that we were first hearing about COVID. We were hearing about, you know, what was going on overseas, especially in China and Southeast Asia, and then starting to spread other places. By the time we got to the end of December of 2020 and vaccines were starting to roll out, everybody was like, thank goodness. 2020 is over. We don't have to be thinking about that now. We're going to move into a new year. And then 2021 was a lot more of the same, right? We had periods of restriction. We had the Delta variant, then we had Omicron, and we still had social distancing and mask wearing and all that kind of stuff, even with the vaccines. So then you get to calendar year 2022, and all of a sudden you sit there and you when you read it, it's 2022, but when you say it out loud, it's almost like, oh my gosh, we've got 2020 again. And we certainly don't want to, hopefully we'll be putting the pandemic, hopefully it moves from pandemic stage to endemic stage, and we start looking towards putting this in our rearview mirror, or putting in the lexicon of normal like the flu, and things move on. So what we want to do today is, as we look at the calendar year 2022, which certainly got off to a interesting, volatile and bumpy start, is to say, okay, as we transition to this phase of the economic cycle, what's out there, what do things look like, and what should we be thinking about? We also know we had, probably the biggest sign up for this webinar that we've had since we started doing these, other than our very first one in the midst of COVID. And one of the things that's interesting about that to me is I find that when we have these webinars, that there is kind of a inverse relationship between the amount of volatility there is in the market, the amount of questions and concerns people have with attendance. So the more concern there is and the more uncertainty there is in the market, the more people attend these webinars with us. And we're certainly seeing that play out in our numbers today. So, for those of you who are clients of Impel Wealth Management, you know us. But for those of you who are attending, who may be watching this on YouTube or maybe watching a repeat of it on our website, just to take a quick moment, I'm Jesse Hurst, Certified Financial Planner, Accredited Investment Fiduciary. CEO here. I've been doing this for a couple of years now, since 1987. So in August, I hit my 34-year anniversary. I'm 56 years old. This is all I've done for 34 years. And, what we really try to do is focus on really helping people make the plans and execute the plans to have a successful transition from work life to retirement life. We specialize in the areas of investment portfolio management, retirement income planning, which is kind of some art and some science, and estate planning. Nathan's joining us here today. Nathan, you want to say anything about yourself?
Yeah, so thanks, Jess. So, as Jess already said, certified financial planner, credit investment fiduciary. I started in the business in 2013 after leaving active duty from the Army. I was an active duty Army officer when I graduated from undergrad. And so I've just been a part of the Impel team here. It'd be 4 years coming up in June since I joined from the previous firm I was a part of. So.
Yeah, and if you see this smiling picture of Nathan, not that he's not smiling anymore, but he doesn't get as much sleep as he used to anymore. That was taken when you only had 2 kids, and now you have...
I have 3, including a 4-month-old. Yeah, so I have 3 boys that are ages 4 and under. So yeah, sleep comes at a premium in my house as well as peace and quiet too. So
there you go. So and like I said, we'll probably be introducing you to Irene on the next one of these, but let's just jump into what we want to cover today. So, one of the 3 big themes that we want to cover as we look into 2022 is that economic growth will slow, right? But we gotta peg that on both absolute and relative terms, because if you think about it, economic growth is going to slow, but it's going to slow from one of the fastest years of economic growth that we've seen. Economic growth was GDP growth was north of 6% last year, which was the fastest GDP growth that we've seen since the early 1980s. And that economic growth was partially due to fiscal and monetary stimulus that came after the original March-April shutdowns due to the spreading of the original version of COVID-19 coronavirus, which those shutdowns caused one of the deepest, but also the shortest recession that we've seen. It was only 2 months, the months of April and May, but by June, we were back into economic growth cycle again. So we think economic growth is going to slow, but it's going to slow from an elevated level, and it will remain elevated beyond what we were used to seeing. We'll talk about that here in just a minute. And one of the other things that was really kind of unusual about the recession in 2020 was not only that it was the shortest recession ever, but it was led by the service side of the economy. Typically, when you have a recession, people who are nervous about the economy stop buying manufactured goods. They stop buying appliances and doing home projects. They stop buying new cars and technology because they want to be conservative. Well, in this recession, we shut down the service side of the economy. We shut down travel and airlines and bars and restaurants and hotels and gyms and spas and so forth. And so at the same time, we sent out a lot of stimulus money that caused people to spend that stimulus money. Since they couldn't spend it on the service side of the economy, they spent it on the goods or manufactured goods side of the economy. So it was a very unusual situation, right? The second thing is that the Federal Reserve Bank, we believe, is going to play a much larger role in calendar year 2022. So I'm gonna jump up. We're gonna try this because we've been told that people want to see our smiling faces more often, and would really like to see us not just see all the screens all the time, but so we'll put this up here like this. So if you think about it, in 2021, the word transitory first crept into the federal bank lexicon in March of last year. And from March through November, we actually saw the Federal Reserve Bank say that inflation is going to be temporary, it's going to be transitory. Part of me thinks that gave a little bit of political cover to the Biden administration and to the Congress to pass the American Recovery Act, which sent out an additional $1.9 trillion of stimulus in March. It also allowed for the passage of the infrastructure, the scaled back, but infrastructure bill that finally passed both houses and was signed in November. Now, the cynic in me kind of looks at this and says, hey, during that time period, Jay Powell, who was the Federal Reserve Bank chairman, was also at a place where he was seeking renomination for another 4-year term as Federal Reserve Bank chairman. And once he got that nomination in November, all of a sudden his narratives changed, right? And you sit there and go, as soon as he had job security, if he was able to freely say, oh, we're going to retire transitory from our language, we are behind the curve, inflation is real, and we are going to have to deal with it. So, there have been a number of what many economists, if you read what's out there, would tell you were policy mistakes by the Federal Reserve Bank, that the Fed's kind of lost some inflation fighting credibility, which they're trying hard to get back, and they'll do that by playing catch up. So, from that standpoint, we also think we're going to see a significant pickup in market volatility, right? Market volatility is likely to rise dramatically over the next year. And if you think about it, there's a whole bunch of reasons why that would be, right? So one is uncertainty about inflation, right? If we think about the course of inflation, if we think about what Federal Reserve Bank policy is going to look like, and we also know that there's always fear of another COVID variant. We know we've also got the midterm elections coming up, which anytime there's uncertainty, markets tend to dislike uncertainty. And the one last thing I'd like to say about volatility at this moment, we'll probably address this again. For those of you who get our monthly investment committee notes from our Investalytics, our National Investment Committee, I put a chart in last month's. That's because we've been saying for the last 4, 5, 6 months, we expected volatility to pick up. Nobody likes when it does, but volatility picking up from a low level, just like economic growth slowing from a high level might still leave volatility higher than normal. This is volatility picking up from a low level of volatility that we saw over the last 9, 10, 12 months. And so the volatility that we're experiencing is actually just kind of normal. Historically, if you look at it since 1980, the market has averaged the average drop in the stock market over the last 40 years has been an average drop of 14% intra-year at least once. We did not experience that last year. We're already close to that this year. So the pickup in volatility, while we expect it, will probably just be kind of normal. So, as we take a look at economic growth, this is kind of a fascinating chart. And I know I was talking with a client the other day, I was sharing this with them, and I said, this is really fascinating to look at. And they said, well, of course you think this is fascinating. This is what you do for a living, right? And, but it shows how fast economic expansions have happened after recession. And then along the horizontal axis, it shows how long they lasted. So if you look at the economic expansion that happened after the 2007-2008 recession that kind of bottomed in March of 2009 after the great financial crisis, which was when AIG, Lehman Brothers failed, we had the TARP program, the Troubled Asset Bank Stimulus Program, and so forth. And you'll notice two things. If you go along the horizontal axis from left to right, you'll see it's the longest lasting recovery, but you'll also see as you look from bottom to top, in terms of real GDP growth, it's the shallowest, which is kind of unusual because the analogy that I like to use, and I'm going to try this, you guys will have to give us feedback on whether you like this, but one of the analogies that I like to use with clients is an economy that's growing at equilibrium is kind of like a beach ball sitting on a lake or on a pool, right? if the economy is the beach ball, just kind of sits there and kind of bounces around a little bit. But if a recession happens, a recession is like shoving that beach ball underwater. And the further you push it underwater, the bigger the recession. When you let go of it, just like if you let go of a beach ball, the bigger the bounce back would be. So the recession that happened after the 07-08 financial crisis was huge, but we never saw the snapback. Now, part of that's because of overhang of debt related to the subprime mortgage crisis and so forth. But it is also, partly due to Federal Reserve Bank policy, partly due to government policy and so forth. So we never got that giant snapback in things that we would have expected, from that standpoint. So, as we take a look at that, let me just bounce back here. And this is what I don't want to do, is distract by bouncing back and forth, right? So if we take a look here, right? So you'll see by contrary, if you look at the far left side, that's the 2020 recession, and this was the bounce back. So you can see how short and sharp that rebound was. It was the fastest rebound we've ever seen, but you can see it's kind of moderating now. So it's kind of taken three phases. When the CARES Act passed and the Federal Reserve cut interest rates and backed the bond market and the banking system, the market took off like a shot. It was almost like that beach ball. It got shoved underwater and then it bounced right back. And then we kind of got into it like a steady growth phase that we saw over here. And now it's moderating a little more. So we would expect from this standpoint, it will look much more like some of these other lines going forward. So a couple other things, right? There's a couple other issues that could give us some good news for the economy. One is that the inventory to sales ratio is extremely low. This just takes the amount of inventory that we have on, in the stock rooms and warehouses and divides it by how long it takes to sell. You can see, when all that stimulus happened, right? First, when COVID shut everything down, the amount of inventory to sales went up because everybody just locked down. Then when the economy reopened and people started spending that stimulus money, you can see that it just killed inventories. Inventories just got crushed. And you can actually see it three times: the initial stimulus check, the second stimulus check, the third stimulus check that people got those money. And guess what Americans do when you give them money? They spend it, right? The Americans are some of the best. If there's one thing Americans excel at, it's at spending money when you hand it to them. So now, as stimulus wanes and our inventories are depleted, manufactured goods are going to have to continue to be manufactured to see this come back up to a more normal level. That should help jobs. It should be good for the economy. It should be one of the things that keeps us out of recessionary territory for the foreseeable future. And then the other thing that's really kind of a unique scenario is the job situation. When COVID first hit, this is the weekly jobless claims. So you can see from where we were in the fall of 26 months after COVID, we were averaging 800,000 new jobless claims a week. And then as the economy continued to reopen, the jobless claims continued to fall. We actually got back down below 200,000 a few weeks ago. It's crept back up because of Omicron and new disruptions related to that. I know I've talked about this before, and it's actually a good place to hand over to Nathan here in just a minute. But there's a report that the Bureau of Labor Statistics puts out every month, and it actually came out yesterday. It's called the JOLTS report. It's the Job Openings and Labor Turnover Survey. And just to put some context around it, when we went through the great financial crisis in 2008, 2009, the number of people out of work went up to about 14 million, while the number of job openings dropped to about 2 million. That meant for every job that was available, there were about 7 people looking for work. which puts the pendulum firmly, or the control firmly in the hands of employers who have way more people applying for jobs than they have jobs available. So that subdues wage growth and subdues inflation. Well, over the next 10 years, right, the number of jobs slowly got filled. The number of people looking for, available to work slowly went up. Yeah, the other way around, right? The number of people came down while the number of job openings. And by the time we got to just before COVID, if you looked in January, February of 2020, we were actually at a place where we had about 7 million jobs available and about 6 million people looking for work. Well, when COVID hit, all of a sudden that flipped again, right? 24 million people out of work, nobody was hiring, and now it's flipped again, right? We have, as of the JOLTS report that was released yesterday on February 1st, said that as of December 31st, there were 10.9 million jobs available and less than 7 million people looking for work. Means that employers are just scrambling to hire people. It's putting pressure on wages. It's putting pressure on wage inflation, which Nathan is just going to talk about here in just a minute. But just anecdotally from talking with clients of mine, they are having to pay up. I talked with a client of mine who works in a corporate setting who oversees hiring of nearly 30,000 employees. And she told nationwide, and she told me they're paying, 30-40% more than they were 4 or 5 years ago for base level entry positions, right? That they're paying for untrained dock workers for distribution centers, $25 an hour. And those kind of labor market disruptions and the inflation that comes with it will continue to be something we have to deal with on the inflation front. So with that, I'm going to flip over to Nathan, let him share with us from here.
Yeah, thanks, Jess. So as Jess already said, one of the key things here is wage inflation is typically known as more sticky inflation. So as we already talked about, when there's more jobs available than there are actual people looking for work, employers are left where they're having to scramble to kind of find good workers, and therefore that leads them to offer these pay increases. So this chart here shows the median wage growth year over year, going back to the 90s, and it was at about 4.2% last year. But actually what's interesting is in certain pockets of the economy, it was actually much higher than that. The leisure and hospitality department, which again was one of those areas that we talked about earlier, was really hurt when COVID first came because you had to shut down all of those areas of the economy. All the bars and the restaurants, the salons, the hotels all closed down. But now that we're in a phase where those are reopening, in order to bring people back to work, employers are having to pay up. And that actually increased wages in leisure and hospitality were up 14% in 2021. And as I kind of hinted at the beginning, wage inflation is known as what's sticky inflation, because if you're an employer and you move someone, their hourly rate, move it up $2, $3, $4, $5 an hour, and then all of a sudden inflation were to go back down, it's really difficult to take that raise away from somebody once it's already in place. So that's what we mean by sticky. Once that wage has moved up, it's very difficult to pull it back from an employment standpoint. The one key thing that we do think is maybe a good thing or a positive is some of this is driven a little bit by shipping and input costs being high right now, or relatively high. And there's some hope that will start to mediate a little bit, which could bring some pricing down. But the hard part is if you're an employer and you're already paying somebody an hourly rate, that may mean that they're going to have to keep their price of their good or service relatively high just for them to maintain their profit margin. So that'll be something that we'll just be keeping an eye on from here. If you want to flip the slide for me, Jess. So another key component when we talk about sticky inflation, in addition to wages, is what's called owner equivalent rent, or when we look at home prices. It's no secret to anybody that's on this call that we've seen home pricing through the roof over the last few years. And since the beginning of 2020, the median sale price of a house in the United States is up 32% in the last 2 years. Now, why is that key? When prices have gone up that high, despite the fact that rates are low, it's pushed many first-time home buyers out of the market, right? The prices have gone up more than what they can afford. And when it goes beyond what they can afford, well, what do they have to do? They go back to the rental market. And so when they're having to go back out and rent, it's just simple supply and demand. There's just not enough available homes or apartments for rent right now for people who are looking. And so therefore, those landlords are able to charge premium rent. Now, one of the key things that Jess and I, those of you who've been in recently, you've probably heard us talk about it. It's kind of a funny in today's world of all of the technology we have in high frequency data, the ways that we're able to get information so quickly and so accurately. When they look at calculating the CPI for owner's equivalent rent, it's kind of a funny way, the way they do it. They actually call every single month, they call 2,000 homeowners in the United States randomly and ask, hey, if you were going to rent your house, what would you rent it? What would the monthly rent amount be? And that's what they use to actually calculate this figure, which just seems kind of a little bit silly in today's world, frankly. But I think what's really key here is with a housing market as tight as what it is, and with supply down and prices high and people having to go rent, the other reason that in the homeowner's equivalent rent is so sticky is that if inflation were to go back, right? Inflation as the end of January, running year over year is at 6%. If inflation were to fall by 2%, those landlords aren't going to be calling people back up and saying, oh, hey, by the way, inflation's now gone back down, so let me lower your rent, right? That kind of doesn't seem to happen. So that's another key reason why we think inflation, especially on the housing side, on shelter, is going to stay high and elevated for the immediate future. So now where does that kind of leave us? One of the things that Jess, talked about that's key for 2022, in our opinion, is what's the Federal Reserve Bank going to do? So this chart that's shown here is tracking what's called the dot plot. So the Federal Reserve Bank has 8 meetings that are scheduled every year. At 4 of those meetings, they release the dot plot, which all the dot plot really is it's an anonymous survey of all the members of the Federal Reserve Bank board. And basically, those members are replying and saying, hey, this is what we think the trajectory for interest rates, the trajectory for inflation is going to be. And then the median response is what's shown here. So if we were to go, if you really focus on the middle there, the 2022, which is, I think, the key, in June of 2021, at that meeting, what that 0.1 shows you is that the dot plot, the Fed was forecasting that in 2022, there might be 1 rate hike in order to help combat inflation, right? That's where we just talked about earlier with the Fed being behind the curve now. But in just in June of 2021, they weren't saying that. They were saying, hey, look, inflation is still transitory. It's going to be here elevated for a short period of time, but then it's going to mediate back to a more normal. So therefore, we don't really see the point, of raising interest rates in any type of aggressive manner. Well, then you can see there at the September meeting, they raised up a little bit more, which would have led to the market to think maybe there's going to be 2 rate hikes. But then you can see the big jump there was at their December meeting. He talked about that, the December meeting where it went up. That was the Fed coming out. It was a big shift in the Fed's policy and their thinking of saying, hey, we realize that we are behind the curve with inflation. Now we're left to potentially have to pay catch up, which means we could now see 3 to 4 rate increases in 2022. Now the Fed's left having to do this real tightrope where they're going to have to say, we've got to try to raise rates to fight off inflation. But if we raise rates too quickly or too aggressively, we're going to hurt that economic growth that Jesse talked about earlier. We're probably going to hurt some of those labor market gains. And they really want to be careful from doing that. So that's what we think the Federal Reserve Bank and what they're going to do this year is really key into market volatility, along with what potentially can happen in the labor markets. So one other thing to think about here is the Fed, by raising interest rates, is essentially pulling back on the stimulus that they've been given by keeping rates low for the last few years, right? We went through the interest rate hike cycle that ended in the fall of 2018, and then they slowly started cutting them back and then cut them all the way back to zero, where they currently are in March of 2020. So that was the Fed. They've been reducing the stimulus to the economy, and if they raise rates, they will continue to do so. And they've been doing this at a point where equity valuations, you can see here, this is going back to the dot-com bubble, are actually earlier this one in late 2020 and even earlier into 2021 were near valuations we hadn't seen since the dot-com bubble. You can see the average is the blue line there, which is a little over 16. This is the price to earnings, the forward price to earnings ratio of the S&P 500. And we're now at a point where we're significantly higher than that. That's right, going back to valuations not seen since the early 2000s. So now it's easy to justify having higher price to earnings ratios in the market when there's low rates, when there's low inflation. But if we think rates are going to rise in the near future, as the Fed has kind of forecasted, and obviously we already know where inflation is, those tend to hurt future potential expectations, especially in your higher growth areas of the market. Your growth stocks really tend to potentially hurt, as rates and inflation rises. So that's just something that we're going to have to continue to watch as we move forward from here. And then last slide before I turn it back over to Jesse, kind of to talk about where we're going to go from here, is this is looking at bond valuations. So what this chart shows is what's called the high yield spread, which all it is looking at what's the premium or the increased rate that you are getting to purchase high yield bonds versus treasury bonds. And that figure on the far right there is showing that it's at near historic low levels, which means, if you're a bond investor, you're not really being compensated for the risk that you're taking by taking on a high yield bond. The reason this is important is, despite the fact that default rates are low in the high yield bond space, again, you're not being compensated for the risk that you're taking by going out and buying those high yield bonds, so that means is that during periods of equity volatility, because high yield bonds and the equities are highly correlated, excuse me. So if you have equity volatility there, right, like you're seeing you saw 2008, 2009, or even during COVID in 2000, when you see that spike up, that means that your bonds are susceptible to weaker returns because you weren't being compensated in the first place for taking the risk that you're by going out the spectrum and buying high yield bonds versus just being in the relative safety of Treasury. So again, these are all things that we're keeping our eyes on as we move forward into 2022.
All right, so with that, I want to just go ahead and remind people that if they have questions, we got a couple questions starting to pull into the Q&A box here, but feel free to scroll over the Q&A button either at the top or bottom of your screen, depending on how yours is set up. You see that Q&A box, you can just hit it and type in your question, and we'll go from there. So with that, we're going to talk about what all of this means and where do we go from here. So one of the things that we're looking at here is margin pressures, right? Because, Nathan in that chart 2 charts ago, let me see if I can get back there, right, showed how price stocks are expensive on a historical basis, right? You can see here the average price earnings ratio for the market is 16.8. If you're above that, the stock market is more expensive. And one of the things, there's one of 2 ways that either reverts back down to the mean, right? It's either E, or earnings have to rise, or P, the price has to come down. We saw a little bit of that in the month of January with the volatility. But then one of the things that's causing some of the margin pressure or potential risk to corporate earnings going forward, not that we think they're going to go negative, but we think there could be some pricing pressure, is if you take a look at producer prices, what manufacturers are paying to produce something minus core inflation, the producer prices are up dramatically. So input prices are up. That's both on the materials and the labor side. And that could put some downward pressure on corporate earnings. Now, we think corporate earnings are going to slow, but still be positive. And just to kind of think about this for a moment, right? One of the things that we're dealing with here is, if you think about the Federal Reserve Bank lowering interest rates, which is typically positive for stocks, and corporate earnings going up, which is also typically positive for stocks, we've been in kind of that Goldilocks scenario for the last couple of years since the initial COVID downturn, because corporate earnings were rebounding strongly, while at the same time, the Fed was cutting interest rates, buying bonds, and providing all types of stimulus. So we're kind of moving from that best box over towards one that's not as attractive from a risk return standpoint, where the Fed's raising interest rates, they're slowing their bond purchases. They've even talked about letting some bonds roll off and not repurchasing them. And then we could also see some pressure with corporate earnings dropping at the same time. That means the rate of growth dropping, right? So I'll give you a great example. Nathan and I talked about this with clients a lot last year. We've seen in the last 6 months, 3 different downturns, 3 different periods of volatility in the stock market. And the first one happened in September, October. And it's kind of funny because it was all over the news for about 3 or 4 days. And then everybody was worried about it. And then you never heard about it again. But there was a Chinese real estate development, real estate management company called Evergrande that in mid-September came out and said, hey, guess what? We owe more than $300 billion of debt and we can't make our loan payments or our bond payments. And everybody was kind of freaked out that what was going on with Evergrande was going to do to the Chinese economy what AIG and Lehman Brothers did to the US economy back in 2007, 2008. Turns out that wasn't the case, but it caused the market to drop 5 or 6%. It turns out that's not the case partly because Chinese collateral requirements for their real estate loans are much more stringent than the United States. We also think that China's government is managing the wind down of that debt because they do not want to they don't want to have egg on their face, especially as we're starting the Beijing Olympics. So, but the reason I bring that up is the catalyst that caused US stocks to rebound from mid-October into early November was third quarter earnings. Third quarter earnings were expected to go up about 28% on a year-over-year basis. And Nathan, they went up what? A little north of 40%?
Yeah. Yep.
Yeah. A little north of 40%. So that positive catalyst of positive earnings expectations caused the market to go up. Now we're going to see whether or not that kind of thing can continue to happen. You know, if corporate earnings go up, 12% or 20% instead of 28 or 30, it's still positive. It's just not as positive, right? It's kind of like Animal Farm. It's all equal. It's just not, some are more equal than others. And third quarter last year was one of those. So with that, let me jump to our next slide here, right? So this kind of bears that out. You can see quarter over quarter earnings growth, right? For the S&P 500. Here's where we hit in the second quarter. This is April, May, June of 20, second quarter, where earnings dropped 31%. But then you can see how strongly they rebounded. Even by the fourth quarter of 20, they started to turn positive. And then you got to remember that corporate earnings are measured on a year over year basis. So you're comparing second quarter of 21 with second quarter of 20. So there's this thing called base effect. And what it means is if you're comparing this number here to this number here, you're comparing it to a very low base. So the corporate earnings look great, but now you're going to be comparing second quarter of 22 against a base of second quarter of 21, which is going to lead to this slowing growth number. So first quarter, quarter over quarter, we're expecting 21% for first quarter earnings, which will be announced in April of this year. But then you can see we go from 92% to 39 to 21, back down into that single digit before it starts growing off that base effect number. So that will continue to put pressure on the P in P&E. So the other thing we want to kind of address here is what are some things that could give us, and I wrote you guys know that Nathan and I write, weekly blog posts. I wrote a piece, a two-part piece over the weekend that you'll be getting in the next couple of weeks here about stock market drops and how much do they drop depending on whether or not the drop is tied to just some sort of temporary economic or political shock versus is it tied to a big recession. And stock market drops that are tied to big recessions, like what we experienced during 2000, 2001 with the dot-com 9/11 scenario, or big recessions like we experienced in 07, 08 that was tied to AIG, Lehman Brothers, and the subprime mortgage crisis. Those tend to be much steeper and much bigger drops. So one of the things we've got to be paying attention to is what are the warning signs for the next recession. One of them is in what's called an inverted yield curve. And it's when two-year treasury, short-term treasury rates get higher than long-term treasuries. Two-year treasury rates are much more directly controlled by the Federal Reserve. They're not controlled, but influenced by the Federal Reserve Bank. And so as the Federal Reserve Bank starts raising interest rates and two-year treasuries go up, if they exceed 10-year treasuries, which are controlled by the market, typically you have a recession at some point in the next 8 to 14 months. There's no sign of that right now. The yield curve is flattening, but it's certainly not inverting. We've got to be watching for things like the index of leading economic indicators. Typically, when the index of leading economic indicators starts contracting or turning over and shows negative growth, generally within same type things, 6 to 12 months, you have a recession. When you see the Institute of Supply Management, when you see their manufacturing index drop below 45, 50 is expansionary, that tends to portend a future recession. So right now, this volatility that we see that we expect to continue is probably just that. It could be opportunities to buy. They're never fun, but like you see during the month of January, we had a 10% drop in the S&P 500 intraday from peak to trough. It was about 12%. The NASDAQ, how much was the NASDAQ and small caps down, Nathan?
I think both of those were down more than 15 intraday. So
intraday, right? But in the last 4 or 5 days, you've seen a big snapback and it's recovered about half that loss. So if you panicked and sold when things were down, you missed the rebound. It's the drops that are tied to the big recessions that we're going to have to be paying attention to. So what does that mean going forward? And again, I know we've got a few questions in the Q&A. If you have any, we're going to jump to the Q&A here after this last slide, right? We think there's going to be, we think there's volatility, but we still have some tailwinds. We still have some things that are positive for economic growth. One is growing consumer wealth. I don't know if any of you have heard the term the great resignation or the great retirement, but during COVID, about 3 million people who were age 60 and over have retired. And as the job market reopened, they've not come back to the job market, right? And part of that is because real estate prices were up, stock prices were up, and the combination of that causes what's known as a wealth effect, and people feel more confident and have retired. But that same wealth effect allows people to be able to, allows people to feel confident in spending in the economy, which keeps the economy afloat as well. So then the second piece of that is low consumer debt servicing costs. If the Fed raises interest rates 3 or 4 times this year and the Fed funds rate goes from 0 to 1%, that's still pretty low, right? I was talking with a client the other day who said when he bought his first house in the mid 80s, his mortgage was at 12%. So he can't believe that people are complaining that mortgages might go from 3% to 4%. He said, in the early 90s, he was thrilled that he and his wife were able to refinance their mortgage debt from 12% to 7.5%, right? So, which is kind of funny to put it in perspective. But right now, because of stimulus, because of wages going up, consumers as a whole have less debt and it's at low interest rates. So when you look at consumer debt as a percentage of income, it's at like the lowest level it's been in 30, 40 years. Third thing is supply chain issues are abating. So let's talk about this for a minute. When if any of you have been out there to buy a car, right? You know how rough it is. Nathan, how long did it take you and Lauren to get a new car when you decided we're having a third baby and you needed a car that could hold 3 car seats?
6 months. We ordered one in May and we got it in November. Only 2 months too late after having the baby, basically.
Yeah. So did you guys tie him to the roof of the car for the first 2 months, or?
Yeah, that's right. Yeah.
You rotated which kids could go which places, right? Yep. So you can't get a car out there, right? Because there's not enough microchips to produce in the cars, to put in the cars. So Nathan, tell them about what's going on over at the Kentucky Motor Speedway.
Yeah, so Ford, continues to roll F-150s off the line like clockwork. And if you know me, I'm a car guy. So I think it's actually over 30 years now, Ford F-150s have been the #1 selling vehicle in the United States. So Ford continues to produce these trucks, but they are all the way built, except they are missing some of the final computer chips that are requiring these semiconductors in order to get them ready to go out to the dealership lots. So back in 2021, about 6 months ago, Ford started stashing them on the infield of the Kentucky Motor Speedway. And at one point in time, they had between 4,000 and 5,000 pickup trucks that were fully completed, other than missing a couple computer chips, just waiting for them to show up. So you've got all these people who want to buy a truck that's fully built and just sitting there, can't be purchased because you're lacking one key component to get them off the lot, or onto the lot, so to speak.
So while at the same time, and by the way, there's lots like that in Michigan, there's places all over the place sitting with these cars, right? So at the same time, the microchip companies, Intel, Taiwan Semiconductor, Texas Instruments, are all ramping up production. I think a lot of people saw that last week or 2 weeks ago. Who was it? Was it Intel? It is doing the factory down
chip factory in Columbus. Yep.
$20 billion they're spending down there, right? So eventually, as stimulus wanes, as people don't have the stimulus dollars to spend on goods, and as supply chains catch up, some of those supply chains could abate. And one of the things we think we could see is you could actually see this, where there's no cars available. All of a sudden you could have a whole bunch of cars, because you could have the cars that are being manufactured now, as well as the chips in the cars that have been sitting there for months. We did have one client tell us last week that some of the electrical casing that they've made that's environmentally friendly in these newer vehicles is ethanol based. And apparently the mice and rats love it. So they might have an issue other than microchips. They might have to replace some electrical components as well. And then we still have the lingering stimulus, right? You still have people that have more money in savings than they have. They still are getting higher wages because wage inflation is up. So what's that mean, right? Part of it is we want to, and with this, we'll jump to Q&A. So again, if you have any, let us know. But, part of that means where do we want to invest, right? There's always opportunities. One of the things economist and market strategist Richard Bernstein, who's been around for 30 years, said in a webinar that I watched recently, said when you have one idea, .com stocks in the late 90s, real estate in the mid 2000s, they lead to these bubbles of valuation because everybody en masse is over allocating capital there, which drives up pricing. But what it does is it leaves pockets of the market where money's not flowing, there's not enough capital, and prices are low, and it provides opportunity. So in an environment like this, learning from what we saw in the late 90s, value stocks tend to do well, dividend stocks tend to do well. Smaller company stocks that have lower PE ratios tend to do well. Emerging market stocks that are tied to China, where we see slowing growth, tend not to do as well, but Europe historically tends to do well. And then inflation-related stocks or inflation-related investment opportunities, commodities, infrastructure, treasury inflation-protected securities, real estate, all tend to do well. So now it's a matter of balancing those opportunities, maybe trimming some back out of the areas that aren't as attractive on a near-term Fed raising interest rates, reflationary environment, rotating some of that capital to areas that do well. We also know that long-term high-quality bonds, that when interest rates go up, those bond prices go down, tend not to be a great place to be. So with that, I'm going to close. I'm going to jump over to Q&A that we have here. And let me bump over here. We'll come back to this. I want to say thank you for listening. Nathan and I can talk about this for a really long time. We enjoy it. We both try to be students of the business. If you look at the stack of stuff that we read each month, it's generally 600-800 pages of economic and political stuff. And again, we've got our National Investment Committee that's meeting next Monday that includes our partners from our firms in Atlanta, Cincinnati, Baton Rouge, and also from Kansas City that will all be meeting with us next week. And you'll see our report come out from that. So again, follow our weekly market insights. We believe in financial planning, right? Investments don't have a purpose unless it's to help us meet our financial goals. And, again, we've been named by Forbes as one of the best in state wealth managers. So with that, let's jump to Q&A. Nathan, what do you got for us today?
Yeah, I got three. You've actually kind of touched on two of them already. So hopefully we can go relatively quick. First one is, what does overseas market looks like, and where should I or shouldn't I be investing?
Yeah, that's a great question, because overseas markets, especially Europe, Japan, and so forth, have lagged the US for years and years. It's actually been the longest period of underperformance that we have seen in the last 40 years. And it's so funny to me, because when I started in the business in 1987, they had just signed the Maastricht Treaty to form the European Union. Europe was hot. People were suggesting that you should allocate 50% of your portfolio there. And just like any other hot spot, it was awesome until it wasn't, right? And now we've gone through a period of time where it's not been so hot. We think that the European Union still has more stimulus. They're not planning on raising interest rates or reducing their bond balance sheets as quickly as the Federal Reserve Bank. Their inflationary pressures, which hit an all-time high this morning, there was a report on it, are still not nearly as bad as where they are in the US. And by the way, one of the things, I think there's a report that I wrote a couple of weeks ago that hasn't come out yet. I think it's coming out next week, that actually talks about inflation, which last month was 7% on the consumer price index. If you looked at the way the government measured inflation in calendar year 1980 and used the same formula, inflation right now would be at 14.9%. The Bureau of Labor Statistics has actually changed that formula at least 3 times in the last 40 years. All of that leads foreign, especially European value stocks, to be underpriced and have more upside potential than what we see with maybe especially US growth stocks or maybe emerging market stocks. The other thing that's foreign stock, and a lot of people don't think about it, is most gold miners are foreign. There's not gold mined here in the United States. So, gold, surprising to most of us, with inflation up and government deficits up, gold actually was negative last year. So we think that could potentially reverse itself in the coming months.
So, according to analysts, how much of a drop in the S&P 500 could we expect this year?
If you listen to most analysts expect a pickup in volatility. Most of them would not be at all surprised to see what we saw in January, a 10, 12, maybe 15% drop. I haven't really heard too many people, because most economists still consider us to be in the mid phase of an economic growth cycle, right? You start to get into big drops in recession when you get into the latter phase, where you're heading from growth to negative growth and then into recession. We don't see that this year. So, a couple of bounces around, 10, 12, 15% wouldn't surprise us at all. But remember, the average intra-year drop is 14% over the last 40 years. So that's just normal volatility. And it's part of why people invest in stocks over time. If you could get a risk-free return, you'd get a return like you got out of treasury bonds, and you'd earn 2%. If you want the higher returns that come with stocks, you got to take the higher variability that comes along with that.
Yeah. Last question is, since wage growth is high, what factors could cause wage growth to come back down?
I don't think you'll see, I think it's a great question. I don't think wage growth, I think wages on an absolute basis probably will not come back down. Like Nathan said before, once you give somebody a raise, it's hard to go back and take it back. We actually had a client who works a part-time job in retirement who told us last year that during COVID, they got a pay raise, and about 6 months later, the employer tried to take it back, and half the people in that department quit, and they had to reinstate the wage, the wage increase that they had given previously. But wage growth will likely slow if we can see enough workers come back into the market. So that would mean we'd have to see the pandemic behind us. We'd have to see, parents where in a both parents working family, where one of them is staying home because kids are learning remotely. And once the kids can go back to school, maybe we have some more workers join. Once people feel safe going into the workplace, maybe we have more workers join the market, right? The other thing that I'm a big fan of, and some people might be surprised to hear me say this, but I'm a big fan of controlled immigration, right? We don't have the birth rate in the United States is not enough to support the number of workers we need for new jobs. And it's also the number of new population growth is also a key in the GDP growth numbers, right? So you have to have enough new people coming into coming into your population growth to support GDP growth and fill the jobs that are out there. So I'm not a big fan of people just coming across the border undocumented and illegally. But I'm a huge fan of let's open our borders and have controlled immigration and let in the people who can fill the jobs, because we need that and our employers need that. So I think those three things are kind of the key to seeing wage growth. Wages won't come back down, but the rate of growth could hopefully moderate, and that would help on the inflationary side. So anything else from the queue, Nathan?
Those are it. Those are the three that we have.
All right. So with that, we'd like to say thank you for being here with us today. We always enjoy having you here. We always enjoy getting to share. And, for us, if we get a chance to share that message with, 25, 30, 40 clients, hopefully that gives us the opportunity to, to give you some, give you some good information. And, instead of you just reading a report from us, get a little more interactive. So if you have any thoughts, feedback on stuff, feel free to let us know, keep us in the loop, ask any questions, shoot us an email. We're here for you. And we're here for your friends and family if you have people that you know that you think would benefit from what we do the way you have. So thanks for joining us. We'll look forward to seeing you soon. Have a great day. Bye-bye.